What's up guys, welcome back to another video, and in today's video we're going to be discussing the pros and cons of in the money versus out of the money options, what I think about them, and what I personally like to do. We're also going to be talking about what to watch for this week as we have a huge week ahead of us. But before we get into it, if you don't mind just dropping a like and hitting subscribe, it really helps out the channel. Definitely check out the links in the description. We have a free Discord server. I have referral links to Robinhood and Webull where you can sign up and get some free stocks. And I also have, my merch. So if you want to support the channel, definitely go check that out. And make sure you're dropping comments on each video to be entered into the Peak Sportswear shoe giveaway. When I hit 6,000 subscribers, we'll be picking one random winner in the comment section. Now let's get into it. Okay, so an in the money call option is when the strike is below the current stock price, and the out of the money option is the strike above the current stock price. And it's the same for puts, just inversed. So for this example, we're just going to use a call option, and I did find someone else's example, and he says, yesterday when I checked the August 2021 expiry for a $25 call, it was $3.50, so that's $350. And the $10 call was $17. And at the beginning of July, so a month prior to August, he says that the $25 call was 0.5 cents, meaning it only cost 50 cents. So the difference in July and August is about $300 between that $25 call. And the $10 call was $8. So that's about a $900 difference just a month apart. So you can see how in the money doesn't offer much leverage because it costs so much, but the return was 700% on that $25 call and only about 225% on the $10 call. However, the in the money call had a much more reliable price increase, almost a gradual upward slope, whereas the out of the money call doesn't really do much until that price really starts to take off, and then those out of the money calls can go crazy. I'm sure as you've seen on Wall Street Bets just how crazy those calls can get and how much money you could make off of them if they go your way. So the advantages of an in the money call versus an out of the money call is mainly what happens when it gets closer to expiration with the extrinsic value and intrinsic value. An out of the money call starts to become worthless because the likelihood of it meeting the strike price plus premium disappears each day, and that is called beta decay, and that's essentially what eats up your contract. Now the in the money call will still lose its extrinsic value, but you still have an intrinsic value. So you do get something at expiration, even if the contract is worth a bit less than what you paid for it, it's not worthless. This is because someone could still exercise that contract and have the right to buy 100 shares at that strike price, which is lower than what the stock is trading for, making it valuable. So let's say Apple was trading at $117 on Monday, 10/26, and you thought that it was going to shoot way up, so you got an out of the money strike price of $120, expiring on 10/30, so that's the Friday. And that Friday happens to come and Apple actually dropped to $115. That means your out of the money $120 strike gets reduced pretty quickly and pretty much worthless at this point. Meanwhile, let's say you bought a call when Apple was at $117, so on that same Monday, but you decided to buy an in the money $110 strike. Now this costs you a lot more money. However, at expiration, your contract still holds some value. Although you lost money because the price decreased, you didn't lose as much because your contract still holds value because someone could still buy 100 shares under the current price. So that's kind of the difference there. You're still going to lose money if the price decreases, but in the money will still hold some more value. So if this is the case, then why do people buy out of the money at all? When it seems like the only downside to in the money options is higher capital requirements. When would be a better situation to use out of the money over in the money? And it basically comes down to high risk, high reward. People have different risk tolerance, and some would like to place a small bet that could 5x their money, and people buy out of the money because markets generally go up or they're super optimistic about a stock. Now, if you think something will increase 5% and you've done all your homework, then why wouldn't you buy the cheaper option with better return? If you did want to play a bit safer but you were still optimistic about something going over the current price, you could always sell puts instead or buy something at the money or in the money. Now, I personally usually stick to in the money, but Sometimes I will go out of the money, but only if it's months out, almost like a leap, or unless it is an actual leap that's like a year or two out. The other exception I give myself is on debit spreads. I will buy the strike in the money and usually sell the one out of the money. In the money call option has around 50% chance of making you money, and you end up using less capital in the long run because it's less of a gamble. However, your pop is significantly lower. It's just more of a conservative bet. So just to be clear, playing options is very risky and you can lose a lot of money. It's much better to actually sell the call options or sell the put options because you collect a premium for this and it's a nice way to make some consistent money. However, if you did want to be the buyer of these options, here are some things that I've learned. When you feel overconfident, take a step back and don't get greedy. Be consistent but always play smart. Know when to sell and take profits. Keep it simple. Practice patience and don't FOMO into buying. Wait for good setups. The market can do whatever it wants when it wants to, and news beats analysis, especially right now close to the election and stimulus talks. We saw just how a couple tweets can really flip the market, so just keep that in mind right now. When it comes to risk management, I personally invest mostly in my long-term portfolios, and I day trade and play options for passive income and just because I enjoy it. Don't play out of the money weekly expirations ever. It's just not good odds for you. If you're going to play close expirations, play deep in the money next week or spreads, but I prefer to play, a couple months out. Don't go all in ever. This is very dangerous. You want to scale in slowly, you want to diversify, and you want to cut losses quickly. And you can ride profits, but make sure you're taking some off the table here and there. Only put in what you can afford to lose. Always wait for a trend and use catalysts to your advantage, but sell the news always. Okay, so now on to what I will personally be watching for this week. I think this is going to be an insane week and the market could go either way. We have tons of big earnings reports coming and about 170 tech companies should be reporting earnings, so hopefully tech has a big jump. Keep in mind, stimulus talk is still up in the air and this is the last week before elections. So we're just going to be looking out for any updates on this, but I highly doubt we get anything done before the election, unfortunately. Tech also has a big week, like I mentioned. 170 companies plan to report earnings, so we'll see how tech does this week. It could, recover and shoot way up. The major earnings I'll be watching for will definitely be Microsoft, AMD, Apple, Amazon, Facebook, even though I called it out last week and it already ran up quite a bit, so definitely just have to watch to see if it runs up even more. And then Twitter, mainly because of how well Snapchat did. They had crazy good earnings, so we'll see if they run up the same way that Snapchat did. I'll also be watching Apple very closely just because while everyone else was doing great last week, like Facebook and all these other tech companies, Apple didn't really do much, and it was kind of just hanging around that $114 mark. So I'll be watching if it jumps up. AMD has a showcasing on its new card coming out, so we'll see how that event goes and if their stock shoots up. GDP will be released on Thursday prior to elections, so we'll just watch how the U.S. economy does in recovering from a pandemic. I'm not really sure on all that, but it's just news that I wanted to be aware of, and I figured you guys should be aware of as well. Last but not least, cruise lines, so like Carnival Cruise and Norwegian Cruise Lines, those guys, their no sail order is set to expire on Halloween, but it'll likely be extended, but it's just something to be aware of, so I want to see how those stocks do as well. So that's pretty much it, guys, just my thoughts on in the money and out of the money call options and what I personally do and how I play those, and what I'll be watching for this week. I hope you guys enjoyed the video. Let me know what you're going to be watching for this week and what you're looking to buy in the comment section below. Please like and subscribe, and have a good one. Ice, lemonade, my neck was tripping.